Welcome back, everyone. We are starting the second session of our STS synthetic workshop. During this session, if you missed the first one, we'll go deep dive into the STS synthetic regime, and we talk about the practical points that we have so far discovered in the transactions that we are currently verifying. And I'll pass the stage back to Ian and Martina. Just for those who missed the first one, the handout will become available shortly on the help session in the application, the platform, and also there's going to be a recording available straight after. So without further ado, Ian, the floor is yours.
Sure. Actually, having listened to Harry say without further ado, we will probably wait a little bit longer as people are still joining. I can see on my screen. So we will, before we really dive into this, we will wait maybe a minute or so. People are no doubt finishing their lunch. So hopefully you will have joined the first session and found it interesting. This webinar will also be ultimately available for subscribers on our website. Okay. Okay. So I think we will start now. The very first slide is really an information slide. It sets out the rules. The synthetic STS regime, of course, is set in law. It's set in two laws. The first one is the general framework for securitization, known as the STS regulation, sometimes also known as the securitization regulation. That is a piece of law that was passed in 2017, December 2017, came into force in January 2019, and applies to all securitizations, whether they are STS or not, whether they are true sale or not. It's a general securitization framework. It deals with things like retention, it deals with things like due diligence by investors, and of course it was the law that created the STS regime. And then this law was amended in 2021, this year, in April, and this is actually quite important because we will talk about this, but the STS synthetic regime is very much grafted onto the original securitization regulation. It works by way of amendment and adds provisions which cover STS. Also adds some provisions which cover NPLs, which are not going to be the subject matter of this seminar, but it works very much by way of amendment, and this is the second piece of legislation you can see here, which we've called the synthetic STS regulation. So why? Why was STS why was synthetic, not part of STS in the first place, and why has it become part of STS now in 2021? And basically, the elements of the answer to that, why is STS synthetics now a thing, have to do with these four boxes. It's SRT, it's Basel, it's STS, and it's securitization as a capital reduction tool. These are the four things that explain why we now have a synthetic STS regime. And how does that explain it? Well, basically, I said it's an origin story. I'm one of these people who believes that to understand why things are the way they are, you really do need to look at how they were before and how they changed. And so I'm a big fan of historical explanations. And so basically, we have an STS synthetics regime because in 2023, we will have a new capital requirements regime entering into force for all European banks. It's been entering into force in chunks, but it should be all there in 2023. And European banks, as I said in the first session, did try to postpone that or arguing COVID, but so far the public bodies have said no. The new Basel requirements will raise enormously the amount of capital that banks have to hold. And that has caused a lot of concerns amongst banks because raising capital has become a little bit difficult. Profitability for many European banks is not where it used to be, and the amounts we're talking about are in the hundreds of billions of capital. There are various estimations. There's a recent estimation from a Copenhagen think tank. The EBA's own estimation was somewhere around 160 billion, I think. But we're talking about real money. And if you can't raise capital, or if raising capital is extremely expensive, capital is a function of your assets and your risk assets. How much risk do you have on your balance sheet drives how much capital you're supposed to have. And so if you can't raise capital, then the obvious thing to do is, well, there are two obvious things to do. One is not to lend, and that is also something that is concerning politicians, which is why the STS regulation passed. The banks have said, well, I will simply not lend, thank you very much. And that's not music to the ears of politicians. Or, second option, is to remove risk from your balance sheet. That can be done by selling assets, but considering the numbers we're looking at, the volumes we're looking at, there are not a lot of buyers for that kind of volume at a price that makes sense. And so you can reduce assets, as we know, via SRT, basically via securitisations, which affect significant risk transfers, which we talked about in the first part of this seminar. So Basel comes in, you're going to need a lot more capital, don't know where to find it. Maybe we should turn towards reducing our asset-based securitization. Can do that, both true sale and synthetic. But here's the problem. One is the systemic risk of bad securitization. As far as the public authorities are concerned, 2007, 2008 was a crisis driven by, or at least sparked by, bad securitizations. And so there is a real concern that, or there was a real concern that you don't want securitization to grow the way it did in 2005, 2006, as a prelude to the 2007, 2008 crisis. You need to make sure that if securitization is going to be a key tool in the armory of European banks to manage their capital, it has to be good securitization, however you define that. Another concern, very much a concern of prudential regulators, is that banks are going to pretend that they are removing risks on balance sheet. They're going to enter into deals that really don't genuinely remove the risk. And so that the regulators, if they're not careful, will agree to reducing capital for banks. And then when it turns out that the transfer of risk was fake and the risks turn into losses, the banks will not be sufficiently capitalized, they will go bankrupt, there will be a major crisis, and somebody will turn to the prudential regulators and blame them. So, yes, Basel requires capital. Yes, Basel drives you to look at securitization as a capital reduction tool. But what about bad securitization? What about fake transfers? And those two concerns have therefore led to the STS rules, which are supposed to deal with bad securitizations, and the SRT rules, significant risk transfer rules, which are designed to deal with the risk of fake transfers. And that is really the reason why today, with Basel III really around the corner, we are looking at the creation of an STS regime for synthetics. So going through the history, if you want, of the legislation, synthetics were not allowed in the original creation of the STS regime. The STS regime created, as I said, it was passed in December 2017, came to force in January 2019. That legislation explicitly excluded synthetics. There was only a true sale. In fact, it's the number one, the first criteria of STS is it has to be a true sale. The reasons for that are historical. We at PCS, together with many other market participants and other trade associations, started to agitate for a STS regime that provided some rules so that the public bodies didn't kill securitization. At the time, this goes back to 2014 when the EBA started writing reports about this. At the time, it was still felt that synthetic securitization really was a bridge too far. It had a very bad reputation. It was, for those of you who've seen the movie, The Big Short, it was all about, tools of mass destruction. It really was the most evil of the evil coterie that made up securitization. And it was really felt that there would be no chance of having a serious constructive debate with politicians and elected representatives if the word synthetic appeared anyway. Oddly enough, by 2017, when the legislation on STS was finally passed, there had been a kind of great movement, a great progress in the understanding and thinking of policymakers, primarily because, going through the STS regime for true sale, they started understanding better how securitizations work. And so when they finally passed the STS regulation, the securitization regulation 2017, the parliament of all groups inserted a request, a requirement, in fact, that the European Commission come back by 2019 with a suggestion about how STS for synthetics would work. And it is fulfilling that mandate from the Parliament to present an STS securitization regime, at least in concept, that led to the Commission introducing the amended regulation. And so that was the amended regulation that was passed in April 2021. It was delayed by a variety of political accidents involving taxation, involving Australia. For those of you who haven't followed it, it was quite bizarre, but it was what it was. And therefore this passed in April. And just as I said, a reminder, it does two things. It creates an STS regime for synthetics. It also deals with NPLs, and it amends some of the NPL provisions that flowed out of the original securitization regulation to make it easier to securitize NPLs. So that's sort of the background of the legislation, but it doesn't actually explain why it mattered, why you wanted an STS regime for securitization, for synthetic, securitization. If you look at the STS regime for true sale, it was supposed to provide investor protection so that an investor could buy an STS transaction knowing it met a certain standard. And in exchange, STS for true sale provided benefits for certain kinds of investors, particularly bank and insurance investors, by giving them lower capital requirements if they were investors in these securitizations. Now, pretty much all investors in the synthetic world are not banks and not insurance companies. There's some insurance companies, but really not a lot. Secondly, the synthetic securitizations they are purchasing or funding or entering into are mezzanine or first loss. And the capital requirements for those, if you're a bank or an insurance company, are horrendous. And they are horrendous even under the normal STS true sale regime. So it's a little bit difficult to understand why you would ask for an STS synthetic regime in respect of investors who either don't care because they're not bank and insurance companies, which is the large majority of them, or even if they were banks and investment and insurance companies, really have very little benefit to get from it because the capital requirements are so high. And this is where you have to turn back to the CRR. In our view at PCS, the slightly absurd and illegitimate way in which CRR works, and I know that I've had that discussion very recently with a prudential regulator who would violently disagree with my interpretation of the CRR, but there it is. I'm an opinionated person, and that's my opinion. The reason why STS synthetic is important is very, very different from the reason true sale STS is important. STS synthetic is important because of something called non-neutrality. There is a non-neutrality principle in securitization when it comes to capital requirements in the CRR. What does that mean? Well, let us say you have a pool of assets called pool X. And let us say these are corporate loans, and let's say the pool is $1 billion. Well, you will go to the CRR and you will find out there are many tables and rules. Corporate loans, you apply the formula, and that will tell you how much capital you need to hold against that pool of $1 billion corporate loans. We will call that number KX. Now let us assume that you securitize that pool of $1 billion in 3 tranches. Tranche A, tranche B, tranche C. Tranche A is the senior, B the mezzanine, C the first loss. So you're actually securitizing the entirety of your pool. Whole $1 billion of it is securitized. Technically, the investors are taking the risk of the pool. So if you add up all investors, the investors in the A's, the investors in the B's, and the investors in the C's, you have a group of investors that are taking the entire risk of the same $1 billion. And so logic might tell you that if you add the capital requirements, if those investors were banks, of course, if they're asset managers, it doesn't matter. But if all those, if this is an intra-banking transaction, so a bank with a pool X securitizes it and provides it, and all its investors are themselves banks. So if you look at the entire banking system as such, the amount of risk in this banking system has not changed. It just moved to different players. And therefore, you would assume naively that if you add all the capital for tranches A, B, and C, which we'll call K, KB, KC, then it should be the same as KX because it's the same risk. And you would be naive because that is not what happens. What happens is that the prudential regulators at Basel have decided that securitization creates, in and of itself, additional risks. And as a result, K, KB plus KC is pretty much invariably larger than KX. So if you securitize a pool of $1 billion corporate loans, €1 billion of corporate loans, the amount of capital that you have to hold against that $1 billion of corporate loans in the banking system as a whole has now increased. And it has increased by something called the P factor, which was randomly chosen. It seems, well, I have to be a bit careful what I say there, but basically it's a random number. It's not a number derived by any analysis of data. The P factor is what increases the capital. Okay, so far so complicated. But what does that mean? Well, what that means is that if you are a bank with €1 billion of corporate loans, €1 billion of corporate loans, you have to have KX, capital. Now, you are going to securitize B, synthetically. You're going to remove all the risk for the B tranche, which is, let us say, 100, the attachment point is at 100, the detachment point is at 300. So that 200 million of B is now being securitized. That's great. You will lose the capital required for that tranche. But you and above the detachment point, so between 300 and $1 billion, you'll keep that on your books. In theory, that means that you would have to keep KA, the capital for A. And if there wasn't non-neutrality, the capital for A is obviously smaller than the capital for X, because capital for A plus capital for B plus capital for C would be equal to capital for X, and therefore if you've removed KB, KA is obviously less. And if you keep the bottom, the first loss, KC, you will have KA plus KC, but it'll be smaller by KB. But you have non-neutrality. And that means that pretty much, and this is highly complex mathematics, which I try to avoid on principle, but basically KA, KB plus KC, as we've seen because of non-neutrality, is greater than, and it's often substantially greater than KX, sorry. And the result of that is that by securitizing synthetically B, you are now left with KA, which can be as high, and in some cases higher, than the KX you had when you had the entire pool at risk. So you end up in a situation where you have removed the risk of the mezzanine, you've removed the potentially the expected loss risk, you've met the SRT, but you now have to have capital for the senior tranche. And that senior tranche can be only marginally better capitalized, or in some cases as badly capitalized, and in some cases even worse capitalized. In fact, the result of where it is worse capitalized is so absurd that even there the prudential regulators actually have to cap. They've had to cap their own formula so that you don't end up having more capital having got rid of risk. So we can talk endlessly about how aggrieved people like PCS feel about this structure, but that is the reason. The reason is, under the new Basel rules, the capital that you have to hold as the holder of the senior tranche of a synthetic securitization as an originator just usually completely removed or substantially removed any benefit from doing the securitization. What was the answer? The answer was to allow the STS regime to apply to synthetics, which will allow you to apply to KA, the senior tranche that you retain as a bank, the lower capital requirements which are provided by the STS regime, and that diminished some of the pain that non-neutrality imposed on you. And so that's the reason why we have a synthetic STS regime, because it is a way of diminishing the anomaly that you can lose risk and require more capital. I'll now pass you on to my colleague who will take you through some numbers and some rules.
Okay, hello everybody again. Yes, as we have just heard, the motivation for actually getting the STS verification lies in the numbers, lies in this complicated calculation, which leads to too high risk weights if you leave it as that. So you can actually really see that on this table, because looking just at a tranche A, risk weight without STS, depending on whether it's a 1 year or 5 year maturity, or you're more likely to have 5 year maturity, 20% is way too high, or 30% for your risk weight. And this actually, for both credit quality step 1 and 2, reduces to 10% if you have an STS and SRT obviously as well. So 10% is the number that you can achieve. So this is the motivation for getting STS. And we have in this table, the third column shows you the difference, the increase of risk weights that you have from non-STS to STS, which clearly shows that STS is a rather good idea to have in order to decrease your risk weights. And this is the reason why STS, in combination with SRT and for synthetic transactions, is just a way of, I mean, in my view, getting back to the numbers as they should be. I mean, you shouldn't have more than 10% risk weight for a senior tranche. So this is a way to mitigate against these new bar rules. Moving on to the next slide. There we are. We've been talking about tranchings and examples for a while. What we've put together here is just an assumed synthetic transaction and an assumed economics. I mean, this is really just an assumption that can be very different in reality. So we've taken this from an example, and depending on the asset class, the granularity, and so on and so forth, these numbers can actually deviate quite a bit. But what I want to show here is actually the same, pretty much the same for all examples that you can think of. So what you see here is a pool of $1 billion. You have a small junior tranche of 20. You have a mezzanine tranche of 100 and a senior of 880. This is quite a reasonable tranching for a certain type of maybe quite granular loan pool, SME loan, something like that. potentially. And the risk weights attached to these different tranches, of course this varies as well, in our example would be using STS, 1250 for the junior, because this is just the first loss piece. Then 660% is in our example for the mezzanine tranche, and 10% risk weight, as we saw before, for the senior. If you have do the calculation of how much capital do I have to attach to each tranche, then what you do is you take the risk weight times the tranche size times the capital, which is 8% regulatory standard capital, and you come up with the result being in millions, say 7 million, 53 million, 20 million. So what you can see is that the 8%, the 80 million that you have capital against the 1 billion pool actually divides itself up in a very interesting way. You've got 20 in the junior, which is the expected loss, is what you expect to actually also lose in that portfolio. Then you've got 53, which is a really high number, in the mezzanine tranche. This is the so-called unexpected loss normally, or actually what you really call the risk. It is what you want to also be protected against, because this is the capital that you could spend better than having to hold it against this pool. And then there's the 7 million for this huge 880 million tranche. So you actually don't hold so much capital against a very large tranche of the pool, and you hold more capital against the other two smaller tranches. Now, looking at potential protection premium spreads that you may have to pay for this risk, for selling this risk, this is also an example and can be different, but the numbers are they still show what we want to show. So even if the numbers are different, the result is pretty much the same. So if you have a 10% premium for selling the junior and 6% for selling the mezz, 600 basis points, and 0.2, the 20 basis points for selling the senior risk, which is kind of super AAA risk, then if you do the cost of capital calculation, so if you actually do the calculation of the basis points times the size, what you actually pay out for saving the capital divided by the capital, then you come up with a cost of capital calculation, which is very interesting, because against what you would intuitively think, and you think, oh yeah, to sell the junior, that's going to be really expensive, and to sell the mezzanine is also going to be expensive, you find that actually this is not the case. To sell the junior and the mezzanine is, in relative terms, a lot cheaper than selling the junior, the senior tranche, the super senior tranche, which is a 25% cost of capital if you use our example numbers. So this is actually the reason, and you see it really clearly here, and even if the numbers were different, the relationship between them would still be the same, that it is a lot cheaper to not sell the senior and keep it, and to sell the mezzanine, or even to sell the junior tranche. Which is why we're seeing a lot of mezzanine tranches being sold, but we have also seen junior tranches being sold, and this can be rather efficient. So you can actually get a significant release of capital if you sell the lower tranches. So this is the calculation which we wanted to share with you, just to get an idea of, I was talking about the decision tree earlier, about who are we going to do this with? Is it going to be funded, unfunded? Who's the counterparty? Is it going to be 0% risk counterparty or not, etc.? This is one of the decisions, and also the tranching, the exact look at the tranching and the cost of capital involved in selling the risk is another one of these calculations you have to do until you have made your final decision of how to set up your synthetic transaction. Moving on, I was going to talk about the key provisions in the new regulation of the synthetic, for synthetic transactions. So, as I mentioned before, the retention requirements are exactly the same as true sale securitizations. Now, obviously, as we said before, if you do end up selling the junior tranche, you need to make sure you still have a retention, which is often the vertical tranche, meaning that on each and every asset that you sell, you retain 5%. And the regulatory benefit provided is, of course, lower if you have STS for the senior retained tranche. So you need to make sure you have STS. And then you've got the criteria for synthetics, which use the same names, really, simple and standardized and transparent, as we know, plus some extra regulation on the topic of excess spread and special things that verification agent and so on that only have to do with synthetic securitizations. And because what the regulator has done is that they took the true sale criteria and kept it as much as they could, reformulated some of the provisions, but it's basically pretty much every single provision that we know from the true sale transaction is back in the synthetic deal, except for the very first 5-6 points, which are the true sale points, and added another whole set of criteria to do with, as I said, synthetic access spread, collateral, and so on, the instruments, the credit event, the verification agent. And of course, that all adds up, and we end up with what we think is about between 145 and 160 criteria, depending on what structure you have, that we need to go through checking. So it is actually even more work for you, apart from all the other decisions you have to make when you set up a transaction as an originator or when you buy a transaction as an investor. You need to look into a lot of points like the credit events, and you have more criteria for STS to check. And third-party verification agents are available. This third-party verification agent being the what we are, PCS, available on the same basis as they are for true sale transactions. So talking about what I just said before, what have they done? We used to have, or we still have, for true sale, Article 20, Article 21 and 22, simplicity, standardization, transparency. Article 20 has changed into a kind of simplicity plus, or maybe plus and minus, because of course the true sale provisions have gone away. Instead, we have other provisions for the synthetic transaction. The standardization has turned into standardization plus, and transparency has also turned into transparency plus, all under Article 26, 26B, C, and D are the equivalent regulations. And then there's Article 26E, which is here on top in red, which are the synthetic additions. Now going into some of the key notions under the simplicity, under the first Article 26B, the originator needs to be a prudentially regulated EU-based bank. You can have several originators, but they all need to be under the same, in the same group and regulated by the same regulator. So it can be a group of banks or financial institutions, or it can be one bank. You can have several balance sheets, but they need to be consolidated in some way so that they are actually, at the end of the day, one consolidated balance sheet. The exposures have to be on the balance sheet. So what you can't do, and you used to be able to do that a long time ago, is to just say, I'm protecting this name, whether I have it or not. it doesn't matter. I'm buying protection for it. You can't do that in synthetic STS transactions with SRT. You actually have to have proper exposures towards these names like loans, or can also be credit lines. You can also have other types of financings like SPV-based financings also, but they must not be SPV as in securitization financings, but they can be certain corporate exposures which have a special financing vehicle, and very often corporate exposures, but also all the other asset classes that we know from the true sale world are actually allowed for STS. So that's also the big difference to the Article 270, that nowadays you can also have consumer loans and other assets in the securitization. You need to have SRT, as we have said many times, and homogeneity is also still there. The homogeneity requirement is the same or very similar to the true sale. We are still waiting for a new RTS which will specify a few of those points where it's not quite clear what qualifies as homogeneous and what doesn't qualify as homogeneous anymore. But what is for sure the case is that you have to have the same origination, basically same origination procedure for these asset classes, and the same type of servicing, and ideally within the asset class it shouldn't be too diverse, but the true sale homogeneity criteria probably come quite close to what we expect to see in the new RTS, although we expect some slightly looser criteria around the corporate loan world, which ones would be still considered homogeneous and which ones not. Because obviously, for example, geographic distribution might not play such a big role in when you're talking about loans as it would for true sale, because you don't have all the true sale homogeneity to look at. And then you have the old rules of not including any credit impaired borrowers. They're exactly the same as we know them from the true sale world. Under the standardization points, a really important one is that pro rata amortization is allowed. Pro rata amortization, once again, makes your calculation that we just looked at in a simplified form more interesting. It can be efficient to have pro rata amortization. Obviously, you need triggers to stop pro rata, which is also an interesting one, because if you switch from pro rata to sequential, in true sale, you're protecting the senior investor, obviously. In synthetic, if you are not actually targeting a senior investor, but a mezzanine or junior investor, switching from pro rata to sequential actually doesn't protect the investor, but more protects the originator. So this is a very interesting feature, and with a completely different aim for the synthetic transactions. Then you have the verification agent. This is the verification agent that has nothing to do with us looking at STS, verifying STS, but it is the verification agent that verifies credit events and losses. And under standardization, you also have all the requirements that we know from the true sale transactions. They're all back in there in the synthetic world. And one of the really important ones is that historical data needs to be shown, and this is the same as for the true sale. And the assets need to undergo an audit. So there is the audit requirement, which is under standardization or transparency. The audit requirement, which is the same as for the true sale. So what you need is you need to audit before you do before you close the transaction. You need to audit the initial pool, or it can be the provisional pool, but it needs to be representative of the initial pool. And you need to do a sample audit on a 95% or more confidence interval, and it needs to be a loan-to-file audit, meaning that the borrower file is checked against the data in the system. This is the classic audit requirement, which came into the true sale world and is now also coming into the synthetic world. There may be some transactions, some synthetic programs out there which have been going on for years, which did not have this requirement and did not do any audits before closing the transaction. This, I'm afraid, is a new requirement which will need to be done. And next to this classic loan-to-file audit, on top and in addition, we also need to do the eligibility criteria check. It's very important that all eligibility criteria are met. That's a system check against the loan tape information. Under the transparency requirements, the Article 7 disclosure comes in. So everything that you needed to report for the true sale transactions, all the different disclosures will also be needed for the synthetic transaction, although the reporting template is a different one, because the transactions are private, the template is a lot freer. The disclosure requirements, of course, include the reference register, which is one of the other new terms. The reference register being it's like really the loan tape, or the loan file, which shows every single exposure that you have in there. Names don't necessarily need to be shown. If it's a blind pool, it can be blind pool, it can be a non-blind pool. But if it's a blind pool, then you have an ID number for each reference obligation, and you need to show, for each reference obligation, you need to not only show what is in the pool, but this is also a requirement, you also need to show the overall exposure that the bank would have to such a reference obligor. This is important because when there is a credit event, of course, the credit event is on the overall loan or the overall exposure to the obligor, and say you have 500 million of exposure to an obligor and you have securitized only 100 million, then it is rather important to be able to understand when the loss is worked out, etc., what the proportion is that actually falls into this securitization and the risk the investor takes. Then there's the synthetic rules under 26E, which under transparency requirements, I mentioned the historical data which need to be shown, and the cash flow model. The cash flow model is also something that is a bit strange, because a cash flow model on a true sale transaction is perfectly easy to understand. You need to show the cash that feeds through the waterfall, and that ends up on an investor notes as principal and interest payments. Now, on a synthetic transaction, you may have no cash at all. All you have is actually the payment, the premium payment of the originator or the protection buyer to the protection seller, and that's all the cash, and that's just a calculation, and it's sort of very simple. But it is required to show this liability model where you can you show the pool, and you show how the note will be, the liability structure will look, what it will look like, and what the payments will be. So it is a lot simpler as a model compared to the model that you need to do for true sale. The synthetic rules, you've got the credit events, and you've got your verification agent, which you need to identify in the documentation, and you also need to sign the mandate for the verification agent. You can't, like in the old days, wait until sometime until the credit event actually happens, but the verification agent needs to be on board from the beginning. And you have the very limited call options. So as I said before, it's very hard to get out of these synthetic transactions. So there's only very limited occasions on which you can. We'll go into that a bit later. The same applies to investors. Investors can't get out of once they're locked in. They're locked in for the life of the transaction. Then you have the synthetic excess spread as a special feature, for which we are also still waiting for an RTS to be absolutely sure how the regulator wants the capital to be deducted. And then there is the list of synthetic structures that is possible, which we've talked about already. And then there's also specific rules on cash if you do choose to invest the cash into bonds or collateral. Now we come to a few more details. I said that the originator calls are very limited. Obviously, if the investor defaults, then the protection falls away, so the transaction can be called. The regulatory call, of course, is also possible. I mean, you do this transaction purely for regulatory purposes. If that purpose falls away, you don't need a transaction anymore, so obviously you can call. The time call is the call after the weighted average life of the pool. You can model that at the beginning and have an expected time call, but at the end of the day, it needs to really be the weighted average life. You cannot call before the weighted average life of the pool, and you need to justify this call towards your regulator when you exercise it. And then you have the cleanup call, 10%. The investor calls are limited to the originator failing to pay or a material breach. So they are extremely limited. The possible structures, you can have guarantees from 0% risk-weighted entities, as we just said before. You can have credit derivatives or credit-linked notes funded. The credit-linked note is the funded structure, and credit derivatives can also be funded by depositing cash against them. Yes, you can also have guarantees that are guaranteed, obviously. Synthetic excess spread can be used, so you can mitigate the effect of losses. You can reduce losses that investors need to actually bear by having an excess spread mechanism. It can be a fixed amount or percentage, or it has to be fixed amount or percentage. And the important thing is that you can't accrue it. You have to use it on a use it or lose it basis. So you would typically probably have a 1 year amount, which would be the 1 year expected loss, that you can use as excess spread as a kind of a buffer that would bear the first losses until losses have to be borne by the investor. Because this is a bit unclear, the exact time when you lose it, whether it's on a quarterly or yearly basis, and how it's actually going to work, and most importantly, how much capital will be deducted for introducing such an excess spread mechanism. We are all waiting for this, for an RTS that is expected, I think, in autumn of this year, to give us in October, I think it was, to give us a clearer view on how this is going to be sort of possible for originators to optimize their structure using excess spread, or whether it will actually just be more penalizing, unfortunately, although it is only excess spread and it is based on the interest the assets earn. But if it is just penalizing from a capital perspective, it's possible that it will actually not be such an interesting feature. So this is still one where we should actually wait for the exact rulings. Here's my decision tree, of which I've been talking. This sort of summarizes what we've been discussing. I don't think we have to go over this really quickly, slowly, because either you decide for a collateral structure or a cash structure, or you decide against a cash structure, and then you can decide which type of structure and whether you have the collateral provisions, whether you can meet them, and you need to also consider the minimum credit rating of the originator, if the originator is supposed to hold the cash. Here it should be mentioned that it is in particular mentioned in the regulation that if the originator's rating is not so high, that is, it's not on a single A level, but it's lower, then it is possible to still hold the cash subject to the in a structure which is not a direct issuance of credit-linked note structure, but other structures, to hold the cash subject to the regulator approving. The good thing in this regulation is that if the originator is not so well rated and just directly issues credit-linked note without an SPV in the middle, then this rating threshold does not have an impact, and subject to the investors being prepared to invest into the structure, it is possible to issue credit-linked notes on a funded basis if your rating is below the single A. And then of course the investors can be 0% risk weighted or not, and you can, if they're not, you can still achieve 0% risk weighting if you have cash collateral, and if you don't have cash as collateral, you need to invest it under very strict rules, and the collateral has to be callable every 3 months. It is actually rather cumbersome to make this work so that you get the capital deduction you would like to have. Are we running out of time?
No.
No. Okay, good.
1 minute.
Okay. Okay, so what are we still waiting for? We're still waiting for a lot of things from the EBA, so let's hope they get cracking over the summer. We need an RTS which defines the homogeneity in this special case of synthetic transactions. We need to understand the pro rata sequential triggers, because there is this, at the moment in the legislation, this wording that we have to include forward-looking and backward-looking triggers, and the definition of what does backward-looking trigger really mean and what does forward-looking really mean would be helpful to have. Although in the SRT rules and the CRR, there are there's already some guidance in the SRT paper regarding forward and backward-looking triggers. Then you've got the disclosure. There's also going to be more on sustainability. Surprise, surprise, also for true sale transactions. This is actually nothing to do with synthetics in particular. Both true sale and synthetic transactions will have to disclose, probably will have to at some time disclose more, and there is definitely some more voluntary disclosure being sought. And then the synthetic excess spread, which we are waiting for an RTS on to explain to us or to the community of how much capital actually needs to be deducted for the luxury of having synthetic excess spread and mitigating the losses that investors would have to bear. And then there's also EBA has also promised to publish on the 1st of November a report on how to structure a green securitization framework. So there's a lot still pending, and a lot has in particular impact on synthetic STS. For me, having now been through a few synthetic STS transactions, I think homogeneity, definitely, we need more information, and also on the synthetic excess spread. That is rather urgent. So next slide. Yes, the next slide is on the grandfathering. We can go rather quickly over this. This is a relatively generous grandfathering wording in the legislation. So it's Article 43, which allows for synthetics that have been done before 2021 to still be declared STS. They can still be grandfathered if they meet the synthetic STS criteria. And as we've seen for the true sale transactions, they actually split the criteria between the criteria that have to have been met when the transaction was done at the time of creation, and the criteria which have to be met at the time the STS label is awarded. And this is something, if you have a synthetic STS synthetic transaction already on your books and you would like to make it STS, you can have a look at if you would potentially comply with these rules. And then there are special rules for the old Article 270 transactions, which are actually automatically grandfathered, whether they meet the new criteria or not, and they can still exist as old 270 transactions, although the Article 270 itself has actually now changed. So they can still pretend they're still living off the old 270 article. Okay, now the next slide just talks a bit about the fact that the third-party verification agents, which is our role, is still is possible for synthetic STS, and it's the same reasoning for which third-party verification agents were invented for the true sale securitisations. It helps the market, it helps the investor due diligence, and it creates a more transparency, and markets helps the quality and the market standard. The third-party verification agent in the is an independent, has to have an independent role, and it, at the end of the day, it helps socialize the cost of the investor due diligence. And as for the true sale, it is not mandatory to use a third-party verification agent. Yeah, I think we've got to the end of this. Yeah. Maybe we should have questions now. Or do you want to talk a bit more about third-party verification agents?
Okay, I think we've now come to the end of the formal presentation. So if there are any questions, we'll obviously be very happy to answer them at this stage. The questions can be typed in the chat message box.
Regarding the new and the old risk weights, and what would be the change, and where you see any differences, and where they're going to be more restrictive. And I'm guessing, Basel III, Basel IV, and when they come into play, and how that would work out against transactions, and whether that will have an impact on doing STS, SRT STS, or synthetic transactions to limit the impact of the new risk weights. That's one of the questions that we have from the audience.
Okay. Well, so it depends what you mean by the old and the new. The risk weights, the new risk weights for securitization are already in place and have been in place for a while. So the risk weight system, of course, is highly complex because it has three different categories depending which way the bank wants to report its risks, you can do it on the IRBA basis, which is the internal ratings basis, which most of the large banks, if not all the large banks and sophisticated banks, report, which basically where they use their own risk weightings, which have to be validated obviously by the regulators. Then you have the ERBA approach, where you can use external ratings to calculate your risk, i.e. rating agencies, Standard & Poor's, Moody's, etc., Fitch. Or finally, you can use the standardized method, where you have neither ratings, internal, no external ratings, and the rules just give you requirements, give you percentages for various types of assets. So depending on which system you're on, the difference, the benefits will be different. Because of the non-neutrality factor that we kind of mentioned, the general view, certainly the view PCS, is that the capital requirements for securitizations are generally, certainly for high quality securitizations, are too high. And the result of this means that if most of the large banking institutions which are on IRBA, which is internal ratings, will their internal ratings actually measuring what is the real risk of those securitization positions, including, of course, the senior tranche of a synthetic deal, which is a securitization position, result in risk weights which are actually very, very low, and therefore bump into the floor. Pretty much invariably, if you're on the IRBA basis, which, as I said, most sophisticated large banks are, not all of them, you will actually bump onto the floor. Now, the floor used to be 7%. And so most securitizations held, including the senior tranches held by banks in the past, used to be 7%. Now, I can't remember exactly when, a year ago, 2 years ago, something like that, those floors were raised. And the differential floor is that the floor is now at 15% for non-STS securitizations and 10% for STS securitizations. And so the new regime for synthetics allows, obviously, the benefit of the lower number for synthetics, the result being that for most securitization positions held by sophisticated large banks, the impact of the allowance of the synthetic regime within the STS regime, so the allowance of synthetics within the STS regime, results in your capital allocation being reduced from a 15% to a 10% level. So basically a 33% decrease. Or looking at it the other way is if you have an STS and then you lose that STS, you're going to have 50% more capital. So that's sort of the rule for most people. But of course, it will depend. If you're on URBA, it'll be a different calculation. If you have particularly risky assets which are not hitting the floor, there's not a lot of that, but if you do, then it's a different calculation. Calculating capital is extremely complicated. It's extremely private to banks, and banks will never let you know exactly how they do it. But you can take it that for most securitizations by large banks, the difference is between hitting the floor at 15 or hitting the floor at 10.
And I think it's good to mention because several of the banks we are talking to have also portfolios under the standardized approach, and there it's a massive difference, and we're seeing that especially for warehousing transactions, whereby being standardized, where your assets have a 75 or 100% risk rate, depending on the type of the asset, and then doing a synthetic drops the majority of the portfolio to 10%, then the impact in capital reduction is substantial. And for a lot of those institutions, we have seen that they are even quoted different spreads depending on it's STS and STS. And in synthetic terms, I think for those institutions, they decided to do a synthetic term for the credit protection. I think you're probably going to see, at least from the benefit of the bank, a big difference of which assets they will decide to do a synthetic transaction, right? Absolutely.
There's a lot of mathematics involved in calculating these things, but certainly the feedback from our clients, because we're working on STS synthetic deals now, and from our contacts in the market is that the difference between STS and non-STS and synthetic really does matter quite a lot. We are yet to find a bank saying to us, I'm not going to bother. I mean, there are banks that says I'm going to struggle to do it, but we're not really coming across so far banks saying to us, I won't bother because it's just not worth it.
One interesting question that came out, and I think, Ian, is going to be your favorite topic. On slide 34, we are mentioning, only for EU banks, originators
Yes.
bank, and how UK banks are going to be treated if synthetic.
Badly. Okay, fair point. I try to get through most days without thinking or mentioning Brexit. I find it's good for my mental health, but I suppose we do have to deal with it. So the STS regulation for true sale is applicable in the United Kingdom because it was passed in December 2017 and came into force in January 2019, and therefore it came into force prior to the exit of the United Kingdom from the European Union. The transition period, actually, technically it's not prior to the exit, but it's prior to the end of the transition period. That transition period came to an end on the 31st of December 2020. And as we said at the beginning of this presentation, the synthetics STS regime was voted and came into force in April 2021. Therefore, at a time when the United Kingdom was no longer bound by or taking laws from the European Union. Therefore, none of what we've discussed today applies to UK banks. Simple as that. There is no UK synthetics regime. We are not aware, and when I say that, it is following discussions with a number of market participants as well as public authorities. We are not aware of any plans currently to introduce a synthetics STS regime for UK banks. Traditionally, it's no secret. I'm not revealing anything here that's dark and hidden. Traditionally, the PRA has been very wary, let's say, of synthetics, or to put it more boldly, basically they hate it. And therefore, whether or not there is any traction within the Treasury, because ultimately it's a political decision. So whether there is any traction within Her Majesty's Treasury to introduce a synthetics STS regime, we think they should. We think it's important. I think it makes no sense to keep synthetics out of the STS regime. It never made any sense. And certainly if the UK does not introduce a synthetics regime, as a STS regime for synthetics, the result is that UK banks will be at a disadvantage when it comes to capital management. And that can't be good if you're a UK citizen. But, that is a case that is going to have to be made by the market to the Treasury, and we shall see where it goes. To be fair, there is a consultation out right now. So if any of the people who are listening to this are UK or have business in the UK, there is a consultation out from the UK Treasury Department waiting for the 2nd of September is the deadline. You can go and respond to that consultation, and you can make the point. Certainly we at PCS will be making the point that there should be a synthetics regime within the STS family.
Yeah, I think you made about capital management. And I think this is a good opportunity to kind of rediscover one of the benefits of securitization versus other funding tools, that it does allow you to manage your capital, manage your risk in a way that you can calculate. But also, I think what people would like to hear is, given that we are working on several synthetic mandates as we speak, and we're coming across various points. You mentioned a couple of them during the webinar, but practically, what do you think is people have to reconsider or do slightly differently versus transactions they've been doing so far? And what are the points that you would bring to their attention. For instance, how you split a portfolio between large corporates and small corporates when it comes to the homogeneity, where it comes to, a couple of the points that I think we have raised the last couple of months when we were looking at those transactions. And probably most people who are listening would benefit from that, let's say, practical knowledge that we have acquired in a couple of months.
Okay. Well, first of all, I already mentioned it, but it is never enough. Never enough times mentioned. You need to do an initial AUP, loan to file audit of the initial pool, of a sample of the initial pool. If it's a diverse pool, it's only going to be on a smallish sample in order to get the 95% confidence interval. But that needs to be done, and that was not done in the past on synthetic transactions. So that's something that you need to bear in mind, because you need to get the auditor going and the information provided, etc. It's an extra cost. On the documentation side, people who do ABCP transactions know that a transaction summary needs to be drawn up. If it's a funded transaction with crediting notes issued from an SPV, then the terms can be used as replacement for transaction summary, but otherwise some kind of transaction summary needs to be drawn up. Historical information needs to be provided. That can also be a little bit complex, because typically on loan portfolios, which are the most frequent asset class that we see at the moment, we're hoping for others to come along. On loan portfolios, it's not so easy to establish a historical track record of LGDs in particular. PDs is simpler, but LGDs, and we need the data as cohorts or vintage information going back 5 years. So this is something that probably people in the past have not necessarily paid so much attention to, although information needed to be provided to investors. But on private transactions without rating agencies involved, this might have been in a different format, so that needs to be looked into. And on the risk retention side, it's not really new. It's the same risk retention rules as we know from the true sale transactions, but in order to capture it in your systems, people need to think of how they're going to do that, because obviously if you do a synthetic transaction, you usually don't truly sell the assets. You still need to flag the assets and flag what is in the pool and what is not in the pool, and what is retained, so that the machine works. So from a for preparation point of view, that needs to be looked into. The other thing is this process of having this initial loss right after the credit event, which is 6 months after, but that's only 2 quarters later, and then you go back to the date of the credit event, and so the credit event, making sure that you have the systems in place to be able to meet this 6-month deadline, which sounds long, but is rather short, for the transaction manager to become aware of the fact there is a credit event, and to get this the credit event verified by the verification agent through notices that get passed back and forth. You give the verification agent, you give a notice that there's a credit event, the verification agent needs to confirm that this is a credit event, and and the initial loss having to be paid out on a very timely manner. These are sort of the things we see. And then there's also the complexity that is added through this mechanism of having an initial loss and a realized loss later on. That adds a lot of complexity to existing documentation, because you need to make sure that you have this reimbursement of investors in case they have overpaid for the loss. And then in some transactions, at least I also see the premium being adjusted in retrospect for the investors if they've overpaid the losses or underpaid the losses. So this can be quite complicated.
Yeah, I mean, obviously, there's all really good points, and they're very good, kind of examples of the kind of things that you have. To summarize, I mean, there's also this issue of at least one payment, which traditionally, you've put names and facilities into your pools for synthetics where they were undrawn.
Yeah.
That becomes more problematic if you've got a one payment requirement. So the general point I would make, or the general consideration I would have, is that the law was not drafted with synthetics much in mind. It was drafted with SRT in mind in the case of the SRT bids, and the people who listened to my earlier comments. It is a bit of a Frankenstein's monster as a regulation, but it really focused on SRT, and it focused on true sale because it took a large part of the so we seem to have gone dark. A large part of the criteria for what makes an STS from the true sale. And so, on the one hand, the STS regime for synthetics is perfectly workable. We're not coming across situations where we say, look, this just doesn't work. But what we would say to people is, first of all, it's a lot more complicated than you think. The interpretations, we've been interpreting these things for 2 years now, over 2 years. We've had a lot of conversation with the EBA. We know how the regulators feel about this, but it's not as simple as you think. And secondly, you cannot go into a transaction which you now want to do STS, which you've done, previously with the same documentation, very similar documentation. You cannot go in and say, it's okay, I've got a good deal, and I don't have to change my documentation. And one of the biggest issues I think we find is that, quite understandably, the originators would like to go in and not change anything. And they say, well, this is the deal I've done 10 times before. I want to use the same documents. I want to use the same machinery. I want to use the same data. And you do have to accept this is a new law. And it's a law that has 145, 160 separate criteria. You cannot expect that you're going to take your deal out of the drawer from last year or the year before, and miraculously, you will need to change nothing. So what we say to people is, look, it's not a difficult standard to achieve. It's a high standard, a serious standard. It's not a difficult standard to achieve, but please acknowledge that you will almost certainly have to do things differently at the edges of your deal. And don't go in saying, here I am, I don't want to change anything, it's going to be okay, isn't it? Because it won't. You will have to change something.
One more thing. I mean, from all the discussion we're having, and mostly our loan portfolios, I think the new regulation, they avoided the EU definition of large and small. And
yes,
it kind of creates a gray area. We'd like guys to talk a bit more about that, because I think underwriting criteria, homogeneity, single country, multi-country, all that stuff becomes, quite different from a true sale transaction. At least.
Actually, no, it's not. It's not different at all from a true sale transaction. It's exactly the same as a true sale transaction. It's just that in true sale, nobody really cared because you just don't do true sale corporate. So the rules are exactly the same as they are for true sale. It's just that the true sale rules are purely academic. Nobody does these deals. I don't think anybody has ever had to kind of look at the homogeneity criteria on a true sale deal for corporate loans. And therefore he was like, yeah, whatever, let's move on. Now, of course, corporate loans are, really the key asset for synthetic securitizations. And so for the first time, people are starting to look at those rules. Now, as Martina mentioned, there is a homogeneity RTS that is coming. For the moment, we are using the old homogeneity RTS, which is the true sale homogeneity RTS. The reason we're doing this is after consultation with public authorities and policymakers, it is our belief, although no guarantee can be given, but it is our belief that the homogeneity RTS that was created for and passed for true sale securitizations will be, at the very least, the basis. It will be the baseline rather than the basis. It will be the baseline for the definition of homogeneity. And that things may get easier,
exactly.
but they won't get harsher.
No.
And there are good reasons to think that, including, discussions, as I said, we've had off the record. So sorry if I may finish. So we're using the existing homogeneity RTS for corporates, and the two ways in which you can get a homogeneous pool according to that RTS for corporates is either all your corporates are in the same country, same jurisdiction. So if you're doing all French, all German, all Italian, all Portuguese, all Finnish, all Dutch, you're fine. That's it. That's good enough. The fact that all your corporates are in the same jurisdiction is enough. If, however, you're doing a multi-country pool, which is often the case, if you're doing a multi-country pool, then all your loans have to either be small or medium, or they have to be all large. But, and this is what I believe you were alluding to, Harry, the definition of small and medium does not, thankfully, follow the definition of SME as it appears in European legislation. For some of you may know that SME is defined in European legislation based on a turnover or a number of employees. I think it's 50 employees, turnover is 50 million. And anything that's bigger than that is not an SME. Thankfully, that's not the standard that was used by the EBA and the RTS, which was accepted by the Commission. It is simply large or medium. It's large or medium and small, and therefore, of course, you do need to have an explanation of why it is that you consider certain things to be medium and small. And we have interpretations internally at PCS about how we would approach this. I mean, this is probably not the time to go through all of that highly technical stuff, but yes, we have spent a lot of time thinking about this. We've had conversations with regulators about this, and we do have a view about how you would do that. But as I said, now we're getting to levels of technical.
One can maybe say that basically the origination has to also show some homogeneity.
Yes,
that's
good
also,
point.
Part of the current homogeneity is that origination and servicing have to be homogeneous in themselves.
Yes. If you want to go to, so we will get a little bit technical. There are four requirements. I have to make sure that I pointed in the right direction so that you can actually see the number of figures. There are four requirements for homogeneity. One is that all the assets were generated on the same underwriting standard, and there's a lot of complicated interpretation around what that means. And again, we've had many conversations with the EBA about this. Secondly, they have to be underwritten. They have to be serviced on the same servicing standard, and again, not always straightforward. Three, I said there were four. Three, they have to be part of the same asset class, and there you do have a list of asset classes. So the RTS does say the assets classes are A, B, C, D, and E, and the final one is anything else. So anything else appears to be an asset class. And the fourth thing is you have to show one or more homogeneity factors. So you have to have same underwriting, same servicing, same asset class, and one or more homogeneity factors. And those homogeneity factors are listed in the RTS, and they are listed by assets. So mortgages have their own variety of factors, and car loans have their own variety of factors. And corporates have two factors. Either you're all in the same country. So if you've got same underwriting, same servicing, their corporate loans, which is an asset class, they're also the same asset class, and they're all in the same country. That's your factor. And you only need one factor. Or the second factor is they're all either small or medium or large. So if you're not in the same country and you can't use that factor, you can use as your factor the small, medium, or large factor. So it's, as I said, it's not a highly difficult standard to meet, but it is a complex standard to meet, and you do have to pay attention to the details.
Would you argue that taking a synthetic transaction and making STS would add more time to what would you normally assume to do, or you think it doesn't really prolong the transaction versus, a transaction with no STS.
Okay. Yeah, I think it will. The first time you do a deal, yeah, it will. And I think likely, not necessarily. It really depends on the institution and the pool. Likely, what's going to take most time is the data. Is figuring out whether you've got the data you need to show.
I'd say it's like all new transactions. If you do a transaction for the first time and you've never done that type transaction before, it just always takes a long time. And I used to say it takes about 9 months, as long as a baby. I mean, maybe it doesn't they're quite as long, but I mean, including everything, as Ian said, looking into the data, into the labeling in the system, how you're going to actually make this reduction of capital possible. If it really is, if you are a real first-time synthetic originator, then I would say it takes quite a while. And then also the SRT needs to get up in most countries. I think it's slightly different in different countries, but you need the SRT approved by the regulator. And for that, you need to calculate some time as well. That can take 3 months. So yes, you have preparation time, then you have, you would spend some time with us doing the STS verification, pointing out some documentational issues or data issues. Then you would have a clear idea of where you're going and what you need for the STS. You need to, at the same time, prepare your SRT memo, etc. Then you need the approval from the regulator if it's the first time. And then you would go back to us and we would finalize. So altogether, that already sounds like a lot of time. So I would say probably a period of 9 months is not unrealistic.
So sorry, just before our kind of listeners run to the hills, we are not saying that for somebody who has an existing synthetic program, has existing deals, it is going to take 9 months. That's an additional 9 months. That's not what we're saying. If you're doing your first ever synthetic deal, it will take you 9 months.
First ever, yeah.
To be clear, if you're doing your first ever STS synthetic, but you have done a long history of synthetics, then it will add some time, but not nowhere near, certainly not 9 months. It will add some time, it will add a few weeks to it. You will need to think, again, the biggest hurdle you're likely to look at or to have to overcome is the data hurdle. Because ultimately, if you need to tell your lawyers to draft something different, that's one phone call and a 20-minute drafting session. If you discover that your data capture doesn't capture the data you actually need, that can be a much longer. It's not usually a call to your IT guy and 20-minute recoding. So that's where I would say really look at the data first. It will add a little bit of time. If you find that the data is okay or needs very few changes, then it will add very little time. A couple of weeks more is what you're probably going to be looking at, as long as your data is in decent shape.
Yeah.
Capture all possible points because there are about 160 criteria totally on synthetic. So we again encourage anyone who is thinking or looking or working on a transaction to contact us directly. And if he has a very specific issue or question regarding one of the requirements, how to interpret or how to understand it, I think that's a better way to address that than trying to capture on this Q&A session every single, let's say, possible permutation of those rules and interpretation. Is that fair point, Ian?
Yep.
Absolutely.
Okay. Thank you for your time. Thanks everybody for joining. As I said, if you go to the chat section, you'll be able to see the handout and take the handout. And shortly, I think the video recordings will be available, and you'll be able to see or forward it or watch it again if you have any questions. Thank you for your time. Thank you all for attending, and I hope to see you soon. Enjoy.
Thank you.
Thank you.
Bye-bye.
All right.